Hi, Dan Ferris, editor of Extreme Value, published by Stansberry Research here. And today's video is inspired by a couple of things. One is a recent little exchange I had on Twitter with an economist named John Hussman. And the other is an idea that I've been floating around since about September or so, that a new golden age of value investing has actually already begun to show just the very beginnings of it have started. And I think it'll pick up a lot of momentum in the next 5 years or so. So let's start out with the first thing first, and that is the exchange I had recently on Twitter with Dr. John Hussman, and let me just bring it up here. So what I did was I wanted to know, John Hussman tracks 5 measures of the valuation of the S&P 500. Most of the time I don't care about this, but I care about it a lot when it's at historical extremes as it is today. So, for example, the price to sales ratio is one of those 5, and it recently made a new high. It was around 2.25 at the peak of the dot-com bubble in December of 1999, and as of yesterday's close, it was 2.28 times sales, just a little peak above. So I thought, well, maybe I should find out, maybe I should check in with Dr. John Hussman and see about the other 4 measures. And he just told me about one of them. I asked him specifically, is this the single most expensive moment in S&P 500 history? Right? If all the other measures were doing what the price to sales ratio is doing, that would be true. But it's not. And here's what he said. He says, our most reliable metric is market cap over GVA, gross value added, basically a comprehensive apples to apples price revenue ratio, including estimated foreign revenues. And he says the record was about 4 weeks ago on that one, and we're about 3% below that level. So to everyone's relief, this isn't the single most expensive moment in stock market history. And of course, it's not the single most expensive moment, but it's darn close still. U.S. equities are extremely expensive relative to all the historical measures that make any sense. And the reason why those 5 historical measures that Hussman follows, and you can follow him at hussmanfunds.com, and I recommend that you do so. The reason why we pay attention to these things is because he's found that these are the 5 measures that correlate the best with the next 10 years of S&P 500 returns. In other words, when those 5 measures are low, the next 10 years of S&P 500 returns are good, they're high. When those 5 measures are very expensive, like they are today, the next 10 years of S&P 500 returns are very low, very poor. So, it's important to pay attention to them right now, but technically speaking, he has informed me that we are not at the very most expensive moment in history, but we're darn close. So that's the first thing I wanted to talk about. Just tell you things are really, the little blip we had, some weeks ago when the market fell 10%, it was nothing. When things get more overvalued, more expensive than they've been almost any moment in history, it takes a lot more than 1 10% correction to fix them. Okay, so things are still really overvalued, but I'm beginning to see some promise of another trend, which I think will follow the current one. And of course, the current one is that growth stocks have outperformed value stocks, and I'll let you know what that means in a second. Since 2009, right? So if you look at the Russell 3000 growth index. These are fast-growing companies that usually trade at very high multiples of earnings and sales. If you compare that with the Russell 3000 Value Index, which are companies with, that trade at lower multiples of earnings and sales, slower-growing companies, generally speaking. If you compare these two things, growth has outperformed value handily since the bottom of the financial crisis in March of 2009. And that happens every so often. What happened in the late 90s? Well, the same thing happened. All the growthy, technology stocks outperformed the value stocks until that bear market in from 2000 to 2003. or 2002 really was the bottom. And then after that, value stocks outperformed the growth stocks from, until the top of the great financial crisis, the housing bubble. And that blew up and people got tired of those stocks, and then they turned around and they bought the growth stocks again. And we're at the probably toward the last 2 or 3 years of that trend. So what comes next? Well, what comes next is that the value stocks outperformed, and I think since we've seen the second longest bull market in history, and it was dominated by these growthy names, I think we're going to see a really nice long outperformance of value stocks. And it won't really get started in earnest, I think. It won't be a full-blown obvious outperformance until we get a big correction. But before then, starting right now, we're finding good long ideas, really beaten down deep value, extreme value, you might say, long ideas. We found one last month, and just generally in a company that's around the mining space. And we've just found another 2 that we're going to write about in the March 2018 issue of Extreme Value. And I won't tell you what industry they're in because they're the only 2 companies in that industry that are worth looking at, very obviously. So, I don't want to give away I don't want to give it away. I have paying subscribers to think about who wouldn't like it if I gave things away. But we're finding these things. And the way you find them is you just look at what's been beaten down and destroyed. The mining stocks were absolutely destroyed from about 2011 or 12 until late 2015, early 2016. And then they've kind of bottomed out, and they're still really cheap. And retail stocks got absolutely destroyed in 2016 and even some more in 2017. And we found one of those late last year. And so we're seeing what I would call green shoots. The first green shoots in this golden age of value investing that I think is going to really get going. And I think by the time it really gets going, you'll have missed the big money and the easy money. So you need to sort of get into it now and think about it now, because by the time it's acknowledged in the press and by the time investors have it on their lips, it'll be too late. You'll have missed it. So the golden age of value investing has sort of begun, and we've covering it. We've begun covering it in Extreme Value, and we've got 2 or 3 picks I think that take advantage of that, and I think they're no-brainers to do a double or a triple within the next few years. And again, this is just a typical cyclical phenomenon that has happened over and over again. Growth stocks outperformed in the late 90s. Then we had a big bear market. Then value stocks outperformed from about 2002 to about 2007 or 8. Then we had a bear market. And then the growth stocks once again took over from 2009 until the present. And you saw a little bit of value stock outperformance in 2016, but that kind of went away pretty quickly, and we're back in the longer term trend, which is still very solidly in place. So I think that just means that there are going to be more good value stock plays in the next, that we're going to find here in the next several months. So that's really what I wanted to tell you today. Stocks are very, very expensive is the first thing I wanted to say. And the second thing I wanted to say is that if you're a value investor, you've had a very rough time since 2009, but I think you're about to have an absolutely wonderful time, starting right now if you're really, really good at digging in and finding good value stocks. So that's about as upbeat a message as I have for you. Be careful out there. I continue to counsel people to hold plenty of cash, short the shares of deteriorating businesses in difficult industries, and buy extreme value opportunities when and where you find them, and only with a substantial margin of safety. And that's it for today. Thanks for tuning in, and I will talk to you next time. Bye-bye.